This is going to be fun to edit out later. All right, we are back recording. Thank you everybody for joining, and everybody who watches this video later. What we are here to talk about is the next 90 days in real estate. And I'm going to go ahead and share my screen so you guys can follow along. We have a short PowerPoint today. Can everybody see that? Can I get a thumbs up or? There we go, thumbs up. Good job. Thank you guys. All right, so next 90 days in real estate and how higher rates can be a benefit to your buyer, or if you are a buyer, higher rates we are going to learn are actually the only thing sort of saving the St. Louis real estate market from being just absolutely insane. And go over the agenda real quick for today. There are quite a few things that we're going to cover. A lot of it is kind of basic, and so it's really just going to serve as sort of a review for folks that have never looked at it from a supply and demand economic standpoint. And we're going to look at what kinds of things are affecting supply, what kind of things are affecting demand, how they might change over the summer, and then of course the critical, what happens next, what do we do about it? So we're going to go over home values, why they've stayed steady even though we have tiptoed into a recession here, and what's probably going to happen as demand maybe picks up, and what's going on with supply. How interest rates will affect all of that will be the next category. And then we'll talk about, of course, what that means and what might happen next. But we're going to start today with housing demand and household formations. And does anybody know what a household formation is and why it's important? Joel, you might have to answer some of these questions because I know you know. What's a household formation, Joel or Elena?
Just somebody that's ready to get into the market to buy a home, build a family, getting married or having kids and things like that.
Absolutely, you nailed it. You dog you. No, the reason household formations are important is because household formations are the only thing that ever creates new demand in the market. So if somebody sells a home and buys a home, if they move from one house to another, that doesn't create any supply and it doesn't create any demand. It just cycles, demand, excuse me. It just cycles through inventory, right? Because they're putting a home on the market and they are going to buy a new home. So it doesn't create any demand for new housing. Historically speaking, we have averaged right about this 1.2 million new household formations each year. And right now we are running at about 1.4 million for the previous 12 months in household formations. What that tells you is that we are above average right now in new households being formed. And again, household formation is when somebody kind of flies the coop and goes out on their own, and they go from living with a family member to now needing a place for themselves. So what we used to be contained under one piece of inventory now needs two pieces of inventory. So we have created demand without necessarily creating new supply. That's what a lot that is going on quite frequently right now. Why is it going on right now? It's because we are sort of halfway through this streak where we have more people turning first-time home buyer age than ever before in history. What this chart shows is birth rates. And one of the reasons we had problems in 2008 is because 2008 was about 33 years after a major decrease in birth rates, meaning new people, new people who were going to be future demand, they were being created at a lesser rate than we were used to. And it created this dip. And that led to a dip in demand in during the 2008 crash, 06 through 08. Right now, if you fast forward that 10, 15 years, we are kind of in the middle of a peak for new household formations, which is going to create new demand. And it's only going to become more and more increased as we go. So the reason that age 33 and the reason we're looking back 33 years from now in this chart is because 33, really it's the range between 31 and 35. It ends up being a different number each year, but that range between 31 and 35 is when most people, that's the average age of a first-time home buyer. And a first-time home buyer is an important metric because a first-time home buyer typically becomes a household formation, which again increases demand. So looking back 33 years ago at what happened with the population, we have more people being born. 33 years later, those people are buying houses, and we're sort of in the middle to front of that wave, which means we have years and years and years where that's going to continue. Does that make sense? Can I get some thumbs up from anybody who is understanding this, or any questions about that? Good, okay. So demand from a demographic standpoint is really likely to go up as we go here. Supply, however, as you guys might know, supply is not going up fast enough. So we have record low, and we say this every year. And if you look at the chart, you can see why we say it every year. We continue to have record low inventory. So inventory is seasonal, which is why you see this nice hill through each year. But as you can also see every year for the last 5 years, the top of the hill is getting lower and the bottom of the hill is getting lower too. And through the pandemic, it really took a hit. And now here we are on this cycle. As the springtime comes, more people are listing their houses because typically they like to do that to move during the summer. They're not wanting to move during the school year, obviously. And that doesn't affect everybody, but it affects enough people that it creates this real estate cycle, and it becomes an annual cycle. In this case, we are increasing to a level that is likely to be below the previous levels. So this is an important chart to understand, because you will hear news articles, and the people that you're buying houses from and selling houses to are going to be hearing these headlines that inventory is increasing. Well, inventory is always increasing this time of year. The question is it going to increase to previous highs? Is it going to increase to lower than previous highs, or is it going to surpass? And are we actually going to grow inventory on an annual basis versus just month to month? Month to month, you can see inventory build throughout the spring, but on an annual basis, it doesn't look likely that this chart is going to take inventory past the 2021 high, which was a record low from the 2020 high, which was a record low from the one before that. So we are still very much in an inventory crunch. When you look at those two data points next to each other, so we have household formations, which is the creation of demand, new people needing houses, and then you've got annual completions, which is how much new inventory is hitting the market, right? Because if somebody moves out of a home and needs to go to a new home, that doesn't increase supply either, right? The only way to increase the supply is to build new supply. So when we look at why we are facing record low inventory year after year, is because the population increased and there was a huge deficit in what new home builders were building in the years after the 2008 crash. So you can see how high annual completions were prior to the crash in 2008, and then how low they stayed for how long after the crash in 2008. So the way I put it is that during that 7 years after 2008, between 2008 and 2015, we were building a deficit in inventory that we are now paying for years later as household formations dropped in response to the economy. Now we have people catching up that didn't buy houses before that now want houses, but the supply is not there anymore. So this is a chart that puts the supply and demand where you can see how they kind of got out of whack for a number of years. And now all of a sudden there's this huge deficit where household growth, the blue line, is far outpacing the annual completions, which is the orange line. Now, you'll see this kind of spike up here in 2022 in response to how much demand was in 2020 through 2021. But I will tell you, this chart's not done for 2023, obviously, but there's been a huge pullback in new homes started in 2023 in response to interest rates going up and builders having 2008 fresh in their memory. They're not wanting to have this big gap again where they're building houses that nobody wants to buy. And so they've been really, really cautious to pull back on building. So this deficit is not really slated to be filled anytime soon. I know that was a lot of economics and math and numbers, but you guys still with me? Does that make sense? How we kind of got here? Does it help to see the history of how this built over time? In fact, I haven't actually put it like this. This is the first time I'm going to say it like this. But one of the things that I'm noticing is when I talk to people who think that home prices are going to come down or they're not going to go up this year, mathematically, that's wrong, right? Those people are going to be wrong. If you think that real estate prices are not going to appreciate this year, they already have, and we're not even through the summer yet. But what I'm realizing is that what they have in their head is how high, how heavy the appreciation was in 2020, 2021, 22. And they say, well, that's not sustainable. And they are absolutely right. I don't have the chart because I wasn't planning on talking about this, but if you look at average appreciation over the last 4 years, it really was unsustainably high. But when you look at this chart and you look at history going back to 2008, the way I've started looking at that is the appreciation was so high over the last 3 years because it was catching up for the last 10 years, if that makes sense. So if you take how much homes have appreciated over the last 15 years, for example, you get a pretty average rate of appreciation. But if you had it frozen for 7 years and then it caught up over the last 7 years. So if you spread it out, really it's average. So really don't look at the last 4 or 5 years as an anomaly. Look at it as catching up to people who were scared to build and buy after the 2008 crash. So that really means to me, we can sort of expect it to go back to average year over year, but back to average means thousands and thousands of dollars of appreciation on each unit that you own over the next 5 to 10 year time frame. Is that fair? All right, thanks guys. So inventory, unfortunately, not great news. Inventory is actually worse than you probably think it is. And here are some national statistics. And in St. Louis, I'm going to actually argue that we are even tighter than the national average for several reasons, which you guys can, feel free to agree or disagree with. But when we look at the real story on home inventory, as we mentioned earlier, we're tracking for about 1.4 million household formations. And for those of you guys that are just joining, a household formation is really the only entry into new demand. It's somebody that used to live with somebody else that now needs their own home, which means we used to be okay with having one house. Now we need two, we need more houses, right? So the demand for new homes is about 1.4 million households per year. And we mentioned that housing starts had actually slowed down. So there are more new homes needed than there are being started each year. And oh, by the way, as a lot of you are familiar with, some of the national housing supply becomes obsolete each year and gets taken down. And a lot of people in this group help do that and rebuild new houses, but not every house that gets taken down gets rebuilt. Sometimes you have 2 lots that become one. Sometimes it just takes a long time, but we are actually losing 100,000 units in inventory, which means the total new supply is actually only 1.2 million. And if we have 1.4 million new households needed being created, we are running a current annual deficit of about 200,000 units nationally. As of the last reporting, there were about 1 million homes on the market. But one of the things that they fail to take out of the headline news when they report these numbers, they don't really know the real story in order to be able to give it to you guys. That doesn't include pendings. So almost half of those units are actually under contract, which means there's only roughly 578,000 homes nationally that somebody can go out and buy. And we're running a 200,000 annual deficit right now. And that's at the current pace. And supply might actually slow down. But this tells you that we are going to be running out of houses within the next 3 years if we don't change the annual supply coming to the market versus the household formations that are causing that demand. Now, a lot of things can change that ratio. So I really don't think we're going to run out of homes in 3 years. I think what will happen is homes will get more and more and more expensive as the demand to supply ratio gets further and further out of whack. Again, a lot of math. Any questions so far? All right, let's just kind of keep pace. If you don't want to speak out loud, feel free to throw any questions in the chat and Elena will pick those up. So just to kind of recap where we've been, demand, we know, is going up from a demographic standpoint, but we also know demand is tied to interest rates. Interest rates are tied to inflation, and you guys might actually be hearing this if you are following any financial bloggers or if you're paying close attention to the financial markets. We're going to talk about what's going on with inflation, because if we know what's going on with inflation, then we know what's going on with interest rates. And if we know what's going on with interest rates, we know what's going on with demand. So a lot of this stuff is tied together in ways that we don't think about every day. But if we start paying attention, we can kind of tell what's coming in the real estate market. And that gives you all, with this information, a leg up on your competition, which is kind of what we're going for here. So it is no secret, it is a well-known, well-studied, well-established fact that inflation drives mortgage rates. The reason why is, deep into economics, but the kind of the Reader's Digest version is that interest rates are tied to bonds. Bonds have a coupon. If you are gaining money by investing in that bond faster than inflation, you're really going to want to buy that bond, and the price of the bond is going to go up, which means the rate associated with it can be lower. If inflation is high, you're not going to buy a 5% bond at 8% inflation because you're guaranteed to lose money on that, right? And so you're going to want to pay less money for that bond, and that bond is going to have to spit off a higher yield in order to attract that dollar to buy it. Now, again, that's a lot of economics, but basically what that says is if inflation is higher, rates are going to be higher. And that's just a natural ebb and flow, supply and demand, basic econ 101 kind of stuff, right? But if inflation comes down, all of a sudden more money will flow into bonds, which will improve interest rates. So if we know what's going on with inflation, we know what's going on with interest rates. If you look at it, this is just a chart proving, this is just a chart, excuse me, it's not the other thing, proving what I just said, where you can see it tied together, right? As inflation goes, and inflation in this case, we're measuring it by the CPI, the core CPI, which is the Fed's favorite measure of inflation, versus the 30-year fixed rate. They're usually not the same number, but they follow each other up and down. Interest rates were held artificially low during this QE period, and inflation was really not yet realized. As soon as the Fed stopped buying mortgage bonds themselves, creating artificial demand, you can see that's when the 30-year fixed rate went up. Inflation started going up sooner. The Fed kept rates down artificially. As soon as they released them, boom, they caught up. It's a pretty tight correlation between the two. So what is going on with inflation? Well, inflation right now is being reported in an annual figure. And this is one of my favorite charts. This comes from MBS Highway, Barry Habib, if you guys are familiar with him. He shows this chart a lot, and I happen to like it. So one of the things that make up inflation, it actually makes up 43% of the inflation reporting, is a metric called shelter cost. Now, shelter cost is not the cost of new homes that people are buying. It's typically made up of several components, but the biggest component is actually rent. So rents were on a tear, as a lot of you landlords know, where you were able to increase. Well, that's slowed down a lot now, right? Are you guys seeing that out in the market kind of anecdotally? Are you guys seeing some of this stuff that backs it up? Or are you still seeing rents go up where you are? Anybody? Bob, you're on mute if you're talking to us.
I'm saying rents are still strong in St. Louis. I'm still edging up.
Rents are still strong in St. Louis, and you're right, Bob. St. Louis is going to be a little bit of an outlier. It's going to be more exacerbated than a lot of the country. And again, we'll talk about why, but that is a good point. For most of the country, rent increases have not come down, but they've slowed down. So they're not increasing at quite as high of a level as they were before. So nationally, because it's an annual number reported, the annual number is the sum of the last 12 months. But the new numbers are coming in lower than the old numbers. And so from an annual perspective, it still looks like it's up here because 9 to 12 months ago, they were still going up. And right now they're coming back down a little bit. And so the annual figure still shows higher than what we know it is today. So we're expecting that number to catch up, which basically is a long explanation and a rationale behind why we believe inflation reporting is going to be coming down. In fact, it's already started to happen. We're already seeing it happen as of the April 12th reporting of March's data. The inflation data for a given month is typically reported on the second Thursday when that month closes. So you've probably heard lenders tell you circle May 10th on your calendar. That comes directly from Barry Habib, who is a financial blogger and economist that we all follow. He's been touting that date really hard because it's the date that they're going to report April's inflation data. And I'll show you here in a few minutes why that is important. But the key takeaway right now is when you hear somebody talking about inflation, they are talking about numbers reported annually. And we know that the more recent the number is, the better it looks for inflation. All right, quick recap again. So interest rates are going down because inflation is going down. Demographics are going up. And what I mean by demographics are going up, I mean that the birth rates that we're dealing with in the country 33 years ago lead us to believe that there are more people who are going to need houses over the next 5 years than there were that needed houses over the last 5 years. So demand from a demographic standpoint going up, interest rates going down. Interest rates going down will accelerate demand going up. Meanwhile, supply is pretty much staying flat or even decreasing. So you have increasing in demand, you have flat to decreasing supply, that can only mean one thing mathematically, and that home values nationally are going up. And again, I created this presentation and I've been giving this presentation. I've kind of been on tour for the last 30 days. We're at the tail end of it here, and we are already seeing the data that home values are going up. I don't have the numbers yet because it's too early in the year, but just based on my own properties and buying and selling in St. Louis, I would argue that we're already up 10% this year, and that by the end of the year, it's going to be a lot higher. Nationally, we've seen about 4% appreciation this year. St. Louis is an outlier, and again, we'll talk about why. So what happens next? What happens next? This is kind of an eye chart, so I don't expect you to kind of dig through this with me, but we've circled May 10th, and the reason why is because we know that on May 10th, when April's data is reported, the number is going to be lower than it was a year ago. So a year ago, we had a 0.5% increase in inflation. And we know we're not going to have, we don't know, but we don't think we're going to have a 0.5% increase in inflation this year. In fact, last month, it was a 0.1% increase, and they were expected to have a 0.2% increase. So the numbers are already coming in lower than expected. And when that happens, if that happens, it's going to look like, from a headline perspective, that inflation went down significantly. And that's going to lead to a lot of people buying bonds. And that's going to lead to interest rates starting to come down. So if you're looking for when are interest rates going to start to come down substantially, it could be May 10th. If all of this stuff plays out like we think it might play out, that interest rates start coming down for about a 90-day window after that. After that 90-day window, I would be really leery of anybody that's predicting rates outside of 90 days because it gets, the farther out you get, the cloudier it gets. But you can typically tell what's going to happen in the short term, barring any other big economic news that we're not expecting. So the takeaway, I know this is a lot to look at. The takeaway is, based on what we know about where inflation has been, we can realistically predict that inflation is going to look lower over the next 90 days, which is going to lead to lower interest rates over the next 90 days. Predicted. So this is important to understand because you're going to be dealing with people that don't understand that we've already hit the bottom of the market. So I started doing these quarterly updates last year, and I do them for mostly my big teams of real estate partners that I work with. And in November, when I gave the Q4 update to a lot of folks, I said, look, we are in a buyer's market in St. Louis. We haven't had a buyer's market in St. Louis for a long time, and this buyer's market in St. Louis is not going to last very long. And lo and behold, by mid-January, the buyer's market was pretty much over. So it's important to know right now that it's already happened. So if you have people, if you yourself is sitting there thinking, man, I want to try to time the bottom of the market here in St. Louis, you've already missed it. The market bottom has already happened. It was very brief, and it happened probably in December of last year. And why is that important? This is another Barry Habib MES highway chart. It kind of walks you through how people think and feel before a market bottom and how people think and feel after a market bottom. And one of the interesting takeaways is that you never know when you're at the bottom because you're still going down, right? You can only know that the bottom happened in the past when you start going back up. And we have absolutely started going back up, which is why I put this arrow here. The St. Louis arrow, we have passed the bottom and we are back in a seller market. There's more competition for housing. And the problem is, this is a short chart, but the chart is going to keep going. It keeps going up from here. And it's important to understand that about the coming months. Why is this important to me? And why did I think it was important to share with you guys? If you're making decisions on buying and selling, I would want, and I've actually, my sister's buying a house right now, for example, my cousin's trying to buy a house right now, for example, I would want, I just closed on a house that I'm going to use as a short-term rental, and I'm under contract for another one that's closing on June 1st. I would want everybody I know that cares about their long-term wealth to buy a house over the next 60 days. I realize as a residential lender, commercial lender, and real estate investor, that's somewhat self-serving. Actually, as a real estate investor, I would love it if none of you guys bought houses and you just left them all for me. But anybody who I care about their financial well-being, we are about to enter a period where all of the math and the data shows that we're going to have a lot of appreciation. And that is probably going to start when the interest rates come down. So the next thing we need to talk about is why we're not going to wait until interest rates come down. We want to buy before interest rates come down. And the math on that's pretty clear. So we are looking at, and this is just an example of how to use this market as an opportunity. This is not profiling an investment property here. This is a chart that I show to my buyers that are buying their primary residences, a lot of first-time home buyers. When you look at how much you might pay for a home and how much you might mortgage, interest rates have risen about 1% over the last year, which has impacted your monthly payment in a not insignificant way. Your home got $3,000 more expensive from an interest rate standpoint using this example. The counterpoint, though, is that even if home values appreciate only 3%, which again, the national estimate is between 3 and 5%. I think we've already hit it for the year and we've just started May. So I think that they are dramatically underestimating the appreciation we're going to get this year. But even if they're right and appreciation is this low, you've still gained $15,000 in appreciation, even though you've sacrificed the $3,000 that you've paid extra for the interest rate. Does that math make sense? Even though rates are higher, because the house is appreciating, you're still making money by buying it. In fact, even if you have to pay for a refinance, which I think most of us that are financing things right now kind of expect that we're going to have an opportunity maybe early next year to refinance these things and maybe even improve our interest rates, depending on the type of financing we got. Even if you're, let's say, pay for a refinance, you still end up with a total net benefit in year one if you're holding that property long term. I'm really going to hammer home on appreciation here because I think that is the kicker in all of this. If you yourself are wondering, should I buy this? Should I hold it? And you're not sure, are we entering a recession? Are real estate prices going to come down? I really just can't hammer home enough that everything we know from a math and economic standpoint points to appreciation. Something weird can still happen, of course, but literally everything that I can show you points to years and years ahead of appreciation, including this chart back from 08. So last time we hit a market bottom, we call it the crash of 08, but really the crash extended into 2012. We really hit a bottom in February of 2012. After we hit that bottom, we had 8% annual appreciation over the next year. So when we hit that bottom last time, we bounced up 8%. I believe we hit the bottom in St. Louis of this cycle in February, which is kind of where that 8% for me, 4% is kind of understating it. We may be looking at closer to 8 to 10% appreciation. This is part of where I'm getting that number. Except the last time we did this, we had 2.4 million units of supply out there. If you remember earlier in this call, I said we have about 1 million units now. So we have about a third of the inventory. We have more people. And last time we were here, we appreciated 8%. Are you guys kind of getting the point on that one? If last time we had 8% appreciation after a market bottom, and this time we have more demand and less supply, we might bounce harder this time. And I do believe that we are already seeing that in the market. Again, just to hammer this home a little bit more, this chart, you can't read it. It's an eye chart. It was too big to really get a clear picture of. But this is every year since 1942 and how much real estate values went up or down in that year. All you need to really know about this chart is that green means it went up and that red means it went down. There's a lot of green and there was not a lot of red. And in fact, almost all of the red was in the 5 years surrounding 2008. Little known fact, if on average, if you bought a home at the top of the market in 2008, it is the longest period in history that it's ever taken you to get back to the value that you bought it for, if that makes sense. So you bought a home in 2008, the value dropped significantly. It started climbing around 2013, and it wasn't until 2015 that your house on average was worth as much as you paid for it in 2008. If you held it another 3 to 4 years, it almost doubled what you bought it for. So that period, 2015 through 2021, such rapid appreciation because, again, we were catching up for those 6 to 7 years after 2008. And if you take out those 5 years surrounding that crisis, that mortgage crisis, real estate almost always goes up over time. Why does this matter? Because, again, most of us as investors, we understand this, but if we have family members, we have kids that don't understand this or that are waffling. I do read a lot of stuff on our youngest generation that's turning, kind of first-time home buyer age, how they don't believe a lot in home ownership. And in fact, they're spending money on different things. There is no greater tie to net worth for the average American than home equity. And that comes from buying a house. In fact, since 2010, since kind of that market bottom timeframe, the average net worth of somebody who does not own a home went from 6,000 to 6,200, whereas the average net worth for somebody that owned a home went from 203,000 to 254,000. So a $50,000 increase in net worth versus a $200 increase in net worth, right? And that's just how it's changing. That's not the net gap. The net gap is about 250,000 of itself. So home ownership continues to be the largest thing that a person can do to build their wealth over time for the average American. Now, again, a lot of us are investors and we are accelerating that, but we are accelerating that by buying and selling more real estate on, typically. All right, the last kind of thing I want to leave you with is the recession talk. So one of the biggest real objections that I get from people is that, hey, all of this math and science regarding home values is great, but in reality, aren't we heading into a recession? And isn't that recession, like if inflation's going down and people are, unemployment is starting to creep up, doesn't that mean home values are going to crash? This chart shows you the shaded areas are every recession that we've had since 1960. The white line is the Case-Shiller National House Price Index. So look at that as basically, for lack of, just to simplify, look at that as the average home value. If you look at how home values perform during recessions, they do not go down during recessions at all, except for what we already talked about, 2008. The reason that is the exception to the rule is because that is the one time in history where the mortgage market and the real estate market caused the recession, not the other way around. So when the economy causes a recession, housing prices stay resilient. The only time in history that the housing environment has caused a recession, that was obviously the outlier. But if you look at how many recessions since 1960, 1, 2, 3, 4, 5, 6, 7, 8, 9, 8 out of 9 times, home values stayed flat, increased, kind of stayed flat here. In fact, there has never been a decade in history where the average price of a home was lower at the end of the decade than it was at the beginning of the decade. And that includes 2000 through 2010. 2000 started here, 08 it peaked, 2010 it crashed, but it still stayed a little bit higher than it started in 2000. So it's just an incredibly good hedge and safe bet over time. Again, we're talking about averages. You can always make a mistake and buy the wrong house. We've all, well, hopefully we haven't all been there, but most of us have been there. And of course, you pay for those mistakes. But over time, over the long term, real estate values only go one way. That is kind of all the meat and potatoes that I wanted to share with you guys. Again, to recap, demand going up. It's going to go even worse when interest rates come down. When interest rates come down, it's going to lead to rapid appreciation. The house that you might be thinking about buying today while you're waiting for interest rates to go down, a lot of people are waiting for interest rates to go down to buy because they think it's going to make if you I don't know what happened, but here I am. So I'm going to go ahead and stop the share there. Actually, you know what? Can you guys hear me?
Yeah, we got you, Mike.
Okay. Sorry, I don't know what just happened. Ultimately, if you buy houses now, you can always refinance them later and expect pretty rapid appreciation. I mentioned earlier that St. Louis, I think, is an outlier. St. Louis, it's harder to build new inventory, and that's why it's an outlier. It's going to be worse in St. Louis than it is in a lot of places because you can't buy, it's such an old city that most of the places you can build within the metro area is already built. So you can go flip a house and make it better, but you can't really create too much new inventory. You have to really get out into Jefferson County and the surrounding counties. You can build there, but as far as the actual metro area, it's just really hard to bring new supply. And when you think about it, I split my time between California and Missouri, and the average first-time home buyer home in my area is actually pretty cheap for California, $550,000. That's about double the average first-time home buyer price range in St. Louis. And the income for people that live in California is not double, which means St. Louis is still more affordable than other areas. So when you have more people, less inventory, and prices that are still affordable, even at higher interest rates, again, demand, as you are already seeing, demand is on fire, and it's going to continue to be on fire throughout the rest of the year. So that's the takeaway. Any question?
So Clea has a question. She said, what about multifamilies? Are you forecasting the same for those?
Ooh, that is a really good question. So interestingly enough, multifamily, you really have to divide in half, right? You've got your multifamily, meaning 2 to 4 units, and you've got your multifamily, meaning 5+ apartments and stuff like that. There's a lot of talk about things really slowing down in the bigger multifamily. So, do you want to hear about 2 to 4 units multifamily, or do you want to hear about the bigger multifamilies, or both? Specifically, what you're asking for is they're very, very different, but it's a really good question. Okay, both. So the primary residence eligible multifamily, your 2 to 4 units, again, there's just not enough new supply coming to the market. In fact, if people like me and Joel get a hold of somebody, we will tell people to buy a multifamily as a primary residence every time, because we care about building wealth for our mortgage clients, right? And so I would say that for the 2 to 4 unit multifamily, the problem is even worse than for single family. When you start getting into the 5+ commercial financed world on the bigger units, we're actually seeing a slowdown in demand, because nationally rents are kind of tapering off, as I mentioned earlier, which concerns people. But also because the financing for commercial lending is typically tied to different instruments, people that were buying big apartment buildings when the rates were 2% and 3% and 4% are going to be in a tight cash flow position now that rates are adjusting to 7s and 8%. So the interest rates are hampering the large multifamily market more so than they're hampering the small multifamily and single family markets. Does that answer your question? It's a great question. Cool. Good questions. So really 3 different markets: single family on fire, small multifamily napalm, and large multifamily, we might be seeing a slowdown there. Any other questions? Good question. So I actually just decided, so Brian asked, what, if any, impact to the short-term rental market? The short-term rental market is so unique, and the St. Louis short-term rental market is even more unique. So again, we do business in a lot of different states. So when I say St. Louis is different, I say that from, we have experience in a lot of different markets, and those markets are trending differently. St. Louis tends to have more restrictions on where you can put a short-term rental, right? Like town by town, you can't just buy one everywhere, which limits the average person's ability to get a short-term rental. So short-term rental market on the demand side, I really don't see slowing down. Recession could impact the business travel market, and it could impact the leisure market, which could be a slowdown in demand for short-term rental. In St. Louis, I don't know if we will feel it, because there's just not that much short-term rental inventory and options. And a lot of the reason why is because, like, I would have loved to have bought one in Kirkwood a couple of years ago, but I can't, because Kirkwood doesn't allow it, right? And so I'm buying 2 in the city right now. And when we researched it, there just wasn't that much competition for that market. So if you buy a bunch of them and create more competition, then it may change the dynamic a little bit here. But I don't think that we're anywhere close to demand dropping off in relation to the supply in this market. I think markets like Florida, which is another area we do a lot of business in, we have a branch in Destin, we have a development going on in Destin. I think that area is at more risk for a imbalance in demand versus supply in the short-term rental market. But ironically, I think they're very, very safe from a home value long-term rental perspective, if that's fair. That is just pure projection. And I don't have any charts or data to back that up. That's just my own observation, if that's fair. Good questions, guys. Thank you. Thank you, everybody, for joining. I'm going to go ahead and kill the share. Actually, sorry, there's one shameless plug that I was going to do. I added in the end here and I forgot. If you find yourself in the primary residence market, one of the bullets, and again, I take this presentation from one that I give to real estate agents that we are trying to work with their buyers. So if you are a buyer or you represent buyers, one thing that we have that can help you, that's solving a real problem, namely the lack of inventory and the competition for each listing out there. We have a program that a buyer can use for, it's actually eligible for rental properties if you're doing conventional financing, but it's only through Fairway and it's only conventional financing, conventional and government financing, I should say, where we can not only pre-underwrite somebody so that they can waive their financing contingency, which makes them more competitive. We actually have a cash guarantee program where Fairway puts their cash out there to back the offer, making it as good as cash in a lot of ways. There's a kicker though, that I think makes it better than a cash offer. And of course, if anybody wants to talk about this one-on-one, I'm not going to take up too much time today with the whole crowd, but if you are interested, reach out to Joel or I, and we can walk you through it. The kicker that I think makes this program even better than a cash offer is that the seller, listing agent and seller, have an alternative option to making us close in cash. So if we add this program to an offer, we can compete with cash offers because we're basically backing it with our cash. But there's an option too that the seller can take. So it's sort of a little detail, a bullet point on this flyer that really we didn't think too much of until we started putting it into practice. In a market where real estate values are likely to go up, the seller, if for whatever reason the buyer can't perform, we will buy the house. But the seller can go, no, what, you guys don't buy the house. We want to sell it to somebody else. We want option two, and option two is that Fairway gives you a $10,000 buyout to the seller. So if you're a seller and you take a cash offer, that person's going to close or they're going to walk away and lose their earnest money. If you take a Fairway cash guarantee offer, we are going to close. The buyer can't walk away because we're obligated to close. And you have the second option of kicking us out and taking $10,000 of our money and then reselling it to someone else, potentially at a higher contract price than you went in to begin with. So to me, that is the little kicker that makes it better than a cash offer and allows our buyers to compete with y'all out there that are just throwing cash at these properties that our people can't get. Shameless plug. Thanks for the time. All right, Elena, that's all I got.
Awesome. Well, if anyone doesn't have any more questions, I guess we can just go ahead and wrap it up. But yeah, thank you all for hopping on today. And we hope that you got some really good information out of this call. And Mike, thank you for doing this for us. We greatly appreciate you always. Yeah. And if anyone needs anything in the future, feel free to reach out to me and I can hook you up with Mike and Joel or anyone from their team. And yeah.
Go from there. I'll stop the recording and I'll send it to you guys as soon as I get it. Thanks, everybody.
Awesome. Have a great night.